Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the nitty-gritty corporate world. And sometimes, just sometimes, we find a little something juicy hidden in the numbers. Today we're diving into an AppFolio Incorporated filing that is all about how they're planning to fuel their future growth. So, what is the big news here? AppFolio Incorporated, a company most people know for its software that helps property managers run their businesses, has just signed a pretty significant deal. Think of it as them getting a bigger financial toolkit to keep doing what they do best, and maybe even expand. The core of this announcement, which happened on the 30th of September 2025, is the creation of a new credit facility. Now, that sounds a bit technical, but what it really means is they secured a new line of credit. It is like having a big credit card for the company, but for much larger sums and tied to specific business purposes. This specific agreement is for a senior secured revolving credit facility. Let's break that down. A revolving credit facility means they can borrow money, pay it back, and then borrow it again, up to a certain limit. Senior secured means this debt is a top priority if anything were to go wrong, and it is backed by the company's assets, which is pretty standard for this kind of deal. The total amount available under this new credit facility is a cool $150 million. They also have sublimits within that for things like letters of credit, which are basically guarantees for transactions, and swingline loans, which are usually short-term loans for immediate needs. The really important date here, aside from when they signed it, is the expiration date, the 30th of September 2030. That gives them a good 5 years to use this funding, which is a solid time frame for executing business plans. What is interesting is that this facility is just a fixed pot of money. AppFolio has the option to increase the total borrowing amount. They can get even more money through additional revolving loans or by taking out term loans, which are loans taken out for a specific period. This flexibility is key. The amount they can add is tied to their financial performance, specifically their consolidated EBITDA, which is basically a measure of their operating profitability. They can borrow more if their profits are high, and they can also do it if they keep their debt level, measured by the consolidated net leverage ratio, below a certain point, which is 3.25 to 1 point. This means they can borrow more as they grow and become more profitable. Now, how much does this new credit cost them? The interest rates are set based on benchmarks, like term SOFR, which is a common benchmark for short, term interest rates, or the base rate, which is usually tied to prime lending rates. The actual rate they pay will also depend on their leverage ratio, meaning the more debt they have compared to their earnings, the higher the interest rate will be. This is called a margin, and it can range from 1.25% to 2.00% for the SOFR rates, or 0.25% to 1.00% for the base rate. So, if they manage their debt well, they get a better price. Besides interest, there are also commitment fees. Think of this as a fee they pay for having the money available, even if they don't use it. It is set at 0.15% to 0.30% per year on the unused portion. This is common for credit lines to compensate the banks for keeping the funds ready. The company's obligations under this credit facility are backed by its parent company and certain of its subsidiaries. And importantly, it is secured by pretty much all of the personal property of AppFolio and its guarantors. This means the lenders have a first claim on a lot of the company's assets if things go south, which is a big deal security. Wise for the lenders. Here is a critical piece for any company financial covenants. These are rules the company has to follow to stay in compliance. For AppFolio, a key one is maintaining their consolidated net leverage ratio at no more than 3.75 to 1.00. This ratio compares their net debt to their earnings before interest, taxes, depreciation, and amortization. If this ratio goes up too high, they could be in breach of the agreement. They actually get a bit of leeway, up to 4.25 to 1.0, during something called an acquisition step up period, which suggests the company is open to making acquisitions and needs more flexibility during those times. The agreement also includes negative covenants. These are restrictions on what the company and its subsidiaries can and cannot do. Things like taking on too much new debt, placing other liens on their assets, making certain investments, paying out dividends to shareholders, buying back their own stock, or merging with other companies are all limited. These are standard clauses designed to protect the lender's interests and ensure the company isn't taking on excessive risk. And of course, there are the events of default. These are the triggers that could cause the lenders to pull the plug. This includes failure to pay, misleading information, breaking any of the covenants we just talked about, defaulting on other debts, legal judgments, bankruptcy, a change in the company's leadership or control, and other financial distress signals. If any of these happen, the lenders can cancel their commitments and demand immediate repayment of all outstanding loans. Being aware of these is super important for any company's financial health. So, what does all this mean for AppFolio? Securing a new, significant credit facility like this is generally a positive signal. It shows that banks are willing to lend them money, and they have structured it in a way that gives them flexibility to grow. The large amount, the ability to increase it as they perform well, and the long maturity date all point towards a company that is planning for sustained growth and potentially looking at strategic opportunities like acquisitions. The covenants, while restrictive, are also reasonable for a company of this size and phase, and they demonstrate a commitment to responsible financial management. Looking beyond the details of the agreement, AppFolio operates in the property technology or PropTech sector. This is a growing area as property managers look for digital solutions to streamline operations, from tenant screening to rent collection and maintenance management. Competition is present, but AppFolio has established itself as a leader. This credit facility provides them with the financial muscle to perhaps acquire smaller competitors, invest more heavily in product development, or expand their sales and marketing efforts to capture more market share. The key will be how wisely they deploy this capital. Investing in innovation and strategic acquisitions can drive significant long-term value, but overspending or making poor acquisitions could strain their finances, especially given the leverage covenants. Ultimately, this is a strategic move to ensure AppFolio has access to capital to execute its vision. It is not a magic bullet, but it is a solid foundation that allows them to be opportunistic and potentially accelerate their growth trajectory. The real test will be seeing what they do with this newfound financial flexibility over the next few years. Alright, that is our breakdown of AppFolio's latest filing. What is your take on this new credit facility and what it signals for the company's future? Do you see them making big moves? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the corporate world. Don't forget to check out our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you in the next one.